So, Eric, the pros, like yourself, look at spreads. Yeah. Retail are just going to look at the overall yield, not benchmark to treasuries. They're just going to see yield going up, and they're not going to like what they see.
Yeah, and I would say, you know, not only yield, if they're playing ETFs, they look at price. So they look at J&K or HYG and look at the price. Certainly, as I said, I think I've told you before, you know, we need to think about spreads. To me, high yield is about spread, investment grade spread, emerging markets, all spread to treasuries. But certainly think retail investors, as you said, are looking at yield or just price if they're playing in the ETF market.
Mona, just in terms of refinancing, a lot of these companies refinanced at incredibly low rates and they push the maturities out as well. Do you see any concern of a lot of companies coming back to market anytime soon and needing to swallow a higher rate?
You know, I think as rates move towards that 3% level on the 10-year, yes, we are concerned that we could see more and more refinancing and then eventually more and more defaulting. But what we really look at on rates is, you know, 3.5% is where you get a 5% mortgage rate, and that's where we're really going to see a slowdown in the economy. Right now, the S&P earnings yield is 4.3%. So when you think about, you know, investors switching from bonds to equities, we're talking about a 4.3% break even. So we're quite a bit of ways from both 3.5% and 4.3%. So right now in the near term, you know, here at 285, keep in mind, the 10 years prior to the crisis, the average 10-year rate, 4.6%. We're nowhere near that yet. So we're not, you know, we're not in panic mode yet. We're slowly getting, and we moved up very quickly. We're slowly getting towards that 3% level, but we're not close to areas where we feel like the economy is at risk.
Cameron Crise, weigh in.
Well, a corporate bond is essentially some mixture of a treasury bond and an equity, right? And the higher the rating of the corporate bond, the more like a treasury it is, and the lower the rating, the more like an equity it is. So the fact that 60-40 has been clattered over the last couple of weeks, it's no surprise that the nominal price of high-yield credit has gone down as well, because you're getting hit on both components. But I think, as Eric said, you know, you have to look at it from, you know, the Joes versus the pros, and the pros look at it in spread terms. I think in actuality, credit has been extraordinarily well behaved when you look at spread, because ultimately buying high yield is essentially like selling vol. So typically, high yield spreads match up very, very well with some smooth chart of the VIX, or smooth trend of the VIX. And obviously, the VIX last week blew out to astronomical levels relative to where it had been, and you know, high yield spreads barely moved. And I think that offers some comfort to the fundamental backdrop that you alluded to, that we're still some ways from the default cycle really kicking in and being a driver of credit spreads.
Lisa?
I should just point out that yesterday we saw the biggest drop in junk bond yields in 3 months. So certainly a lot of people...
You think everyone's too calm around this table?
Yeah, so everyone, well, no, meaning that like everybody was just piling back in. It's over, done, right? Everyone was believing that the backdrop is solid, et cetera. I think there's a big tension right now between the fundamental backdrop, which is pretty solid, and a repricing, a valuation story, because all of these assets are just too rich for a normal rate environment. So that's sort of the tension here, and that's what we're seeing.